Hello, everyone, and thank you so much for tuning in. What I want you to do is I want you to get into the mindset of making sure that velocity banking is the primary tool that you're using to pay off all of these loans, whether it's student loans, whether it's car loans, whether it's home loans, any loans that you want. Okay, I know you can do it. I know you can do it. I know you can place the velocity banking as the primary, because we want to show you how to pay off those massive loans, all right, with the lines of credit, all right? So let's go ahead and do that. We have the two circles, right? One is going to be the line of credit. Now, of course, this doesn't have to be the line of credit that you utilize. You can also use a checking account. You could use a retirement account. All right. Just, any type of account, you can leverage it. That's what velocity banking is all about. And what I go over in my class, you can leverage the line of credit, the checking account, the savings account, the retirement account to get rid of, eliminate those needless, burdensome loans. All right. That's what it's all about. So we're going to go ahead and link that to your loan. So wouldn't it be nice if you had an account that linked to your loans like this? And I believe there is such a strategy. And of course, we can connect you with that. So the line of credit and the loan, it doesn't look like a dumbbell, right? I almost say barbell. But look, the line of credit is linked to the loan, and you're going to be paying it from the line of credit in a way that is going to drastically reduce that loan. Okay, you're going to start with the principal. Can I go ahead and add two more elements here that is going to be much better for you if you keep these in mind? Let me go ahead and add them. Those two elements are the income and the expenses. Absolutely. So, income and expenses. Let's just say it's 5K. The expenses are going to be 3K. All right. Let's go ahead and start out with our line of credit for easy math, let's go ahead and do 10K. And the loan is going to be, let's put that at 10K too. Why not? 10K loan as well. So we got some nice round numbers here, right? And a lot of you are like, man, I got more loans than this. Well, that's okay. That's okay, because the principal is going to be the same on any loan that you have. All right. Now, 5K, 3K, we got the line of credit of 10K and the loan at 10K. Now, one of these loans is going to be calculated different than the other one. Can you guess which one is going to be better for you? All right. Now, many people call the line of credit loans. That's incorrect. All right. But for this example, one of these loans is going to be better for you. And what is that? The line of credit. Why is that? Because the line of credit is revolving. Okay. Make sure you get a revolving line of credit, while the loan is one way. And what's that way? Away from you. Okay. So we want revolving lines of credit as we pay down our loans. So when we have the income and the expenses, let's say 5K and 3K respectively, what are we going to do with the line of credit? Okay, well, we have the loan here. So let's go ahead and let's just take out the loan. All right, let's just 50% that loan. What does that mean? We're going to get $5,000. Okay, that's 50% of our line of credit. $5,000 towards this loan. Okay, 5K towards this loan principal. Oh yeah, towards the loan principal. That's what we need to make sure that we're doing toward that loan principal, because as you attack that principal, all right, you're going to also attack the interest simultaneously. Why? Because the interest feeds off of the principal. And so the smaller the principal, the smaller the interest. Okay, the bigger the principal, the bigger the interest. We don't want that. We want to absolutely attack it. So the 10K, it's not going to be an interest at 10K. We're going to have the interest at 5K. And so we're going to go ahead and subtract that to 5K. As well as, because we got some left over, right? As well as we're going to go ahead and attack the expenses. We're going to pay our expenses as well. So a total of 8K from the 10K is what? Now we got 2K. Now you're saying, CJ, wait a minute. What about credit utilization? My credit utilization is over the 30%. What next? Well, this is what next, all right? Make sure that this is going according to your goals. If you want to quickly pay off this loan, all right? If you want to quickly pay off this loan, you have to have more line of credit towards transferring the line of credit, okay? You're going to do a transfer of interest from simple interest to amortized interest. Remember when we talked about that? And so what you're going to do is you're going to take out that principal as fast as you can. If you're endeavoring to stay under that credit utilization so that your credit score doesn't get hurt, please do that as well, okay? Do that. Now, just to make sure that we're on the same page, if you do the credit utilization, it could be 5 to 10 points off your credit score. But remember, what do credit scores do? They go up and down, right? Okay, so they fluctuate, and you can better your credit score. Of course, we help you with that as well over at Velocity Consulting to increase your credit scores by focusing on the correct thing. And so if you need help with that, let us know. The loan is now at 5K. Your line of credit is now at 2K. But how are we going to pay both the line of credit and the loan? I mean, isn't that asinine, CJ? You now have another bill. No. You got to stop thinking of your line of credit as a bill. First of all, stop thinking like that, because it's not. What bill do you know of that you can pay and then borrow from? Pay and then borrow. Can you go to your electric company and say, listen, I know I just paid you $250, but I'm going to need half of that so that I can also pay. They're going to say, sir, this isn't a line of credit. This isn't a Visa card. Okay? This is an electric company. Your money is now kept in our vault, not yours. You see what I'm saying? This is not a bill, folks. This is your new checking account. All right? So you're going to put the income inside of your checking account. Okay? Keep that direct deposit going to your checking account. Do not have this line of credit set up as your direct deposit. All right? Keep it going to your checking account. But from the checking account, you're going to put that 5K right there in the line of credit. So now you're going to be at 7K. Okay. But of course, we have the expenses again. Okay. 7K minus 3K again is 4K. But notice how 4K is greater than 2K. That means you're going up, going up, going up. Right? So this is what we want to establish. When you're doing this, you have to make sure that your income is greater than your expenses. Does that make sense? Because it's the difference, income minus expenses, that's going to pay down your line of credit. As you're parking your income there, what's paying it off? That cash flow, the 5K minus 3K, which is 2K. Okay, so in 4 months, because you had a balance of 8K, okay, in 4 months, this joker is going to be paid off. Okay, why? 8K divided by the cash flow, 2K. So let's go ahead and give you that formula here. The balance, okay, divided by the cash flow equals your velocity term, okay? B over C equals velocity term, which in this case is 4 months. But you have a different case. So yours may be totally different. All right. So this is how you pay down your loans with your line of credit, with your checking account, with your retirement account. It doesn't matter. All right. What we want you to do is get in the mind frame, help this economy by smartly leveraging what it is the bank is helping you with. They've given you the line of credit. They've given you the banking tools. Now just go out and use them. God bless and have a great night.